Well, hello everyone, and welcome back to Man and Machine here with the PeakBot team and Mark from Harvested Financial, and special guest today, Matt Cashman from the OCC, Principal of Investor Education over there. Matt, what's going on, man?
Nothing much. I'm having a great morning here. I'm sufficiently caffeinated and ready to talk about options, dude.
Amazing. Well, cheers to that. I have become the solo cup guy, but there's just black coffee in here. We've actually talked about coffee a good amount on this show. We've done some coverage on Starbucks and some other things. But anyway, we got a really good show for everybody today. We're learning today, so strap up. We got some of the best educators in the space here. We are going to talk about some things in the world of option selling. So stay tuned. We will have stocks in real life, talking about Meta today and our experiences both with the stock and in real life. And of course, we'll take a glance at PeakBot picks, do some SPY analysis, take a look at the economic calendar for this week and much more. But very excited to get into it. Gentlemen, where do we want to start? We want to get started with stocks in real life?
I think we're going to mix things up. So any of our regular viewers, you typically come in and you'll see us go through PeakBot picks. So we're going to wait on that. We're going to hop right into stocks in real life. Why don't we get started talking about Meta? So Dillon, why don't you kick us off with your thoughts on that?
Okay, wow. Loaded question. Meta. Okay, first of all, I hate calling it Meta. Let's start there. For me, this has been Facebook for my entire life. You know, Ben and I were 30, 31 years old. Facebook was everything. I was late on MySpace. Facebook was, the first social media account I ever had. It was hot. And then, of course, Instagram. I mean, look, I'm on Meta every day. We use it in our everyday lives. It feels like it's all around us. And it feels like it's the circle's getting tighter. The stock scares me. I haven't traded it well. I find it relatively volatile, although I haven't probably looked at the chart in a really long time. So excited to. That's my experience on Meta. I'm already talking too much. Somebody else jump in here.
How much is it moving? What's the delivered vol on this thing?
Let's look at it. Mark, you have any insights on Meta off the top of your head? Otherwise, we're going to pull up some charts here.
Yeah, so Meta, we're looking at like a 30-day vol. I want to say we're in the I'll just pull up the screens directly. So 30-day vol at the money, $700 stock, we're like a 30 vol. So 30's, it's not the craziest vol in the world. It's 50% more than what the S&P is roughly, but 30 on 700 is also meaningful. Those are some of the moves that I think Dillon's talking about there.
Yeah.
I think that's key because Dillon, in the context of PeakBot's bots, right, specifically trend spread is identifying a weekly trend and then playing that weekly trend. But as we can see from this 1 year chart here, I mean, hey, if you were bullish from May to June into July, boom, you would have probably lost a couple weeks there going into August. And then probably lost on this reversal back here because the bot would have indicated bearish. So yeah, we're bouncing quite a bit up and down here. But I'll tell you what, Meta has won me the PeakBot picks competition several weeks.
Yeah, it does.
I'm a fan.
You collect a pretty good premium on it, this stock. Sorry if anybody else is talking. I mean, look, is it at all? What's the highest the stock's ever traded right now? Right, it's at all-time highs. Almost cracking the $700 mark. Look, I think this in a huge portfolio, probably not a terrible stock to wheel, being that it's mostly bullish through some pullbacks, but. What are other people's experience with Meta in real life outside of the stock? I mean, anybody have the goggles yet? Anybody doing that?
No goggles here.
No goggles.
I know somebody that they were so excited about the goggles and got them when they first came out, used them for like 3 days, and that was it.
Collects dust now.
Unfortunately.
I kind of have a no goggle rule in my house.
I like that rule.
I always thought, especially when the $5,000 goggles came out from from the direct competitor of this company that
Yeah.
you would immediately get on like planes and see people in first class wearing them, looking like, and that never really transpired for me. I guess I'm not flying back and forth to Silicon Valley enough, though. But
Yeah. No, you're absolutely right about
I just have a
that.
hard time thinking that goggles like that are really going to take off until they're not quite as cumbersome and heavy and nasty.
Right.
in the face,
We're looking at a lot of neck trouble, I think, right now still.
Which is where I like the partnership with Ray-Ban, right? Pick someone who's
Yes.
actually like got some glasses experience, not just
Yes.
some bolt-on ski goggles.
Bolt-on ski goggles. I love it. That's what they should have called them, Mark. Bolt-on ski goggles.
Clearly, I should be in marketing and not trading.
Yeah, there's a marketing opportunity missed there for sure.
Well, speaking of trading, though, I remember when this stock listed. I remember back in 2012, we were on the floor. We did not get the specialist allocation. You can picture the bigger firm that more likely got that allocation. But I remember opening day, this was one of the stocks that got the tightest, the fastest that I'd ever seen. That typically, it takes a couple days, maybe weeks, depending on like the tier of the name. Within 15 minutes, it was a penny stock practically.
Yeah.
And I think they converted it to a penny even sooner than the typical schedule. Like usually you had to wait 90 days for them to rebalance the penny stocks. It was slammed to a nickel wide by 940 and a penny, the next week because of just the crush of liquidity that came in and traded this. It was impressive from like a market efficiency standpoint. Not as great if you're buying on the bid and selling on the offer, but it was a pretty like awesome experiment in just like how quickly that could happen.
Yeah. Who was the DPM that got it?
Well, typically we were on the Amex, so I was on the Amex floor. I'm pretty sure it began with an S and was the name of a river outside Philadelphia.
And rhymed with Musquatana.
Exactly.
Okay, fair enough.
This is fun. We're having more fun today. I gotta say, the core four here is nice. So a couple things here too. I can't believe we haven't mentioned, the name Zuckerberg yet. When you have a business like this with a leader behind it that's as public as Zuckerberg is, especially as of late, there's so much that can happen to this stock at any time. It's one of those where any piece of news comes out and it's all over the place. But what do we think about, the opportunity here for Meta, obviously with this looming pending TikTok and whatever else? We talked about this on one of our other calls. Zuckerberg's out here offering creators, a lot of money to come and post exclusively on Meta and IG Reels and all this other stuff. Where do we think this stock can go? I mean, what's the ceiling here, do you guys think? I mean, do we just see this thing continuing to go nuclear? Or?
I mean, I think Meta's doing so much as a business right now. It only takes like one or two verticals to really hit for them to see further growth. But I mean, it's the same story with companies these big over and over. It's like, how are they going to continue to squeeze out shareholder value year over year, right? So they're looking for all opportunities. Honestly, Dillon, I thought you were going to go a different direction with that question. I thought you were going to ask us about Zuckerberg's wardrobe change because he looks like he belongs on TikTok now versus Facebook.
Yeah. Well, look, he kind of gives me the heebie-jeebies a little bit. He's a little unpredictable now. Let's look at so what's the market cap?
Look at that market cap. Almost 2 trillion. I mean, again, it's hard to imagine companies being that large and growing even more, right? Like I remember Apple was the first company that hit $1 trillion cap.
Yep.
I remember when they hit $1 trillion cap and my mind was blown. I was like, wow, this is huge. Like, but now it's like, all right, when's 10 trillion coming?
Yeah.
And it's going to happen.
What would happen if you sold it $1 trillion? You'd be down, compared to cash. I mean, Apple's probably 3x since it hit $1 trillion. Well, it has actually, of course. It's 3 trillion now.
Yeah, for sure.
Yeah.
What are some other thoughts here? I mean, again, I've maybe traded this personally once or twice, likely on our trend spread strategy. I'm going to actually just pull up the watch list and see what it would be doing this week. But any other thoughts or experiences on Meta here, whether it's in the market or outside of it?
Well, I was actually about to pull up my screen, and as we were looking, we were talking about some stats about Meta. I didn't realize how rich this volatility risk premium has been historically. So this is over like the last 2 years. Other than a period in early 2024, we're seeing some decent premiums of implied over realized. That, you know, this bar right here in the middle is 10%. So we have regular periods where the implied volatility is fully 10 clicks higher than what the future realized is. So, you know, from an options selling perspective, there's been some pretty rich premiums overall. Obviously, you have to get direction right and all that, and you know, there's a lot more to it than just a positive VRP. But overall, this is surprising to see this much risk premium in a name consistently.
Yeah. I think it's interesting when you think about that, taking into account what you also said about liquidity at the beginning, right? Like, this is also one of the most traded stocks, and then theoretically also one of the most liquid stocks as far as options are concerned. And in a situation where you have something that is like extremely liquid and there's a lot of people trading it, and you still have implied volatility that's 10 clicks over the realized, theoretically, you're dealing with something that's like, that's where it really is, right? I mean, like, it's not like just blipped there because someone came in and bought a bunch of straddles. It's blipped there, you know, for a very long period of time, and that's really where it lives.
Yeah, it's a consistently hot potato.
Yeah, exactly. So I don't know what that, you know, from a forecast perspective, I don't ever like give forecasts, but when you look at it and it's giving you that reading for a long period of time, that means that people are trading it that way, and that's where those two things live, you know?
Yeah. When we look at it right now on the trend spread watch list, it's a 14.6% ROI. So it's a $25 spread. You know,
Wow.
We're selling the 30 delta, and this is for a weekly, you know, this is a 7 DTE contract. Well, I guess technically right now it's set up to be 4 DTE. Sold put at the 30 delta is 672.5, and then a bought put at the 10 delta is 647.5. So it's paying $364 in premium on a $25 spread. So yeah, crazy in the premium department. As Ben has mentioned, like, this has really done well for him in the PeakBot picks contest. So Ben, go ahead.
What does this mean for you as the PeakBot trader? Because I know we definitely have a bunch of PeakBot automators on the call
for
here.
For me, you know, if you're asking me, look, like, if you have a sizable account, if I had, you know, 50K in an account, I'd probably start to trade Meta. You know, for me, I don't want to set aside $2,500 in cash on an 18K account. But, you know, for me, I feel like it's, you know, a relatively bullish play. If it's going to collect that much premium and you have a moderate to high risk tolerance, I see you doing this. But of course, not financial advice. That's me, but it's too expensive to play on the wheel. Trend spread's there, you know, got to have a clear trend about it though. What are we looking at?
Speaking of the wheel, this the screen you caught me peeking at behind the scenes was this is my reading of the 30-day covered call over time. So what percent of stock price is a 30-day covered call? 30-day 30 delta covered call. Consistently 1.75, 2% of the stock price. Like, that's a pretty healthy premium that you're collecting on like a 30-day basis. I know your wheel is obviously like more of a weekly trade, but like that 30% implied volatility, that consistent premium in there, like, this is an expensive stock. There's some juice in it.
Yeah, for sure. Any other closing thoughts on Meta? If not, I did want to ask one more question to everybody.
What is it?
All right, final question. In a showdown, would you have Zuckerberg or Musk? MMA.
It's not even close.
Yeah, I agree.
Okay, Elon Musk is an old beat up man. Elon, if you're listening, which you're not.
He's got size on Zuck though.
I don't care. I've watched the dude like walk. He can he's all over the place. Probably wouldn't be able to focus. I got nothing against either of them, but Zuckerberg's swollen right now, isn't he? Guy's in shape.
He has definitely beefed up a decent amount over the last 18 months.
Look,
so
here's the thing. I don't want to
so
fight.
Hold on. Elon is 6'2". I can't find a weight on him.
Okay.
Zuckerberg is 5'7".
No, he's not.
He's only 5.
He is.
Oh yeah, no, very well-known short guy.
Oh, really? He wears
Uh-huh.
lifts. He's
Surrounds
gotta wear
himself with
lifts.
short people. He's that kind of guy.
That guy has
Tom
got
Cruise.
$1 million lifts in every shoe size. For
Oh
sure.
man, yeah, he does. But here's the thing: like, I'm thinking about this right now. I would fight Elon Musk right now. I think I'd be okay without any training in the gym. I saw Mark Zuckerberg throw some punches in on his video. I don't want to get in the ring with Mark Zuckerberg right now. I think even at 5'7", I don't know if I want to do it. By the way, I'm 6'1", 240. All right, I got some size, but I'm not in shape. Anyway,
And you have the reflexes of a jungle cat, which is very, very advantageous.
yes,
You need
yes,
that when you're fighting Zuck.
Sure do. So we got over 740 people listening to me talking about fighting Zuckerberg. So any other closing thoughts on Meta? Great conversation. Interesting stock. Obviously very highly traded. Actually, I do have one more question on it. What dividends on Meta? I'm not a dividend trader. Are they pretty good, or just out of curiosity?
They just recently announced one last year. It was fairly nominal. It was like 50 cents a year or something like that. But I do believe they launched a dividend last year.
Okay.
Yeah, 50 cents a quarter, I think it was.
Oh, cool.
Okay.
Okay.
Good to know.
But
Cool.
yeah, nothing that's going to make me go crazy.
You're not buying Meta for the dividends.
Gotcha.
No.
Good to know. Had to ask.
All
Let's
right.
learn a little something.
Let's learn something, right?
All right.
We got Matt Cashman here again. Fantastic guest. Matt, we love having you on. If you want to bring up your slides here, we're going to let you and Mark jam a little bit. Dillon and I will kind of take the back seat. We'll throw in some comments here and there, but
Cool.
let's teach our audience something.
Yeah, right on. So Mark and I talked a little bit about and what we kind of structured this as was like Vega and how Vega affects pricing. I know that you guys have a cohort of people that actually spend a decent amount of time trading 0DTE options. And I think it's important that people understand the mix of not only Vega, but also Gamma and how that exists when you add like duration into the mix. And so the first thing I want to talk about is what is Vega? And number one is Vega is really just how the option moves price-wise when you move implied vol up and down. And so it's the sensitivity of the option to movements implied vol. So and this slide gives you an idea. It's measured in per 1% change in implied vol. How much does the option move? So the Vega is expressed as a decimal. If you see something that has like what I see here, 0.08, that's what we would call in the business 8 cents of Vega. And if you move the implied vol from like a 20 up to a 21 or from a 21 down to a 20, you would expect that option is going to move about 8 cents for that 1% move. Now, if you were to move the implied vol 10 clicks, you would expect this option to move 80 cents. The interesting part about this is that calls and puts both have positive Vega amounts, and they're expressed that way. You will never see an option that has a negative Vega amount expressed next to it. When you get negative Vega positions, it's because what you've done is sold options, not because the option itself has negative Vega. The Vega is actually a positive amount that moves up and down when you move the implied vol. And so if you're going to move implied vol up and nothing else changes, option prices, both calls and puts, are going to go up. And if you move implied vol down and nothing else changes, option prices, both calls and puts, are going to move down. So I think that's important, right? To set the table as far as Vega is concerned. Mark, what do you think? Anything to add there as far as just the explanation of Vega?
Nope, I think that's dead on. And I think it's super important to differentiate there between this is about long options and short options. This isn't a call and put thing. This is, if you're long options, you have positive sensitivity to vol. And if you're short options, increases in vol will hurt you.
Exactly. Yeah, I think that's really important here. The second thing that I want to stress here is that, and I'm going to move to I think the second slide I have here. Vega is really just a function of time. It's commensurate with the amount of time you have in your option. And what I've done here is I've set up the Vega of the at the money option, how much Vega is in the at the money option. Remember, that's the sensitivity of that option's price to movement in implied vol levels. And so what you have here is 0-day options. That's 2 cents of Vega. That's not very much Vega. But as you go out in time, 5-day options, 10-day options, 30-day options, and 90-day options, and this is just kind of a generic idea of an at the money Vega, look at what this does over time. Once you get out to this 90-day option, you've got almost 20 cents of Vega in it. And so, and if you were to just see this without the graph, you would look at it and be like, because it's expressed as a decimal, it doesn't really drive the point home until you look at it as a graph. And then you see the 0-day option relative to the 90-day option, right? This is your 0 DTE option, and this is your 3-month option out here. And so that 3-month option, if you move vol from 20 to 21, this option is going to move 2 cents. This option is going to move 20 cents. And that's a massive difference. And that's all a function of duration. So that's important to think about also. When you're thinking about Vega, you need to think about it as a function of time, because that's really what it is. And so that's kind of, Mark, what do you think about this relative to how people trade in general?
I think this is one of the hardest things to wrap your head around with Vega. And as soon as you see a curve like this in any kind of charting, you know that it's not going to be as intuitive as you think it's going to be. Right. Because the power of Vega on those long-term options, to your point, can be very significant. And I think that's because the way I kind of like wrap my head around it is you're just giving space, and every single day just widens that range even more. And if, you know, it's like those Galton boards where you drop the ball and they like ping pong down through all the different distributions. Yeah. If you start extending that wider and wider, or extending different rows, like you significantly increase the probability space where that option can land. And it's going to have compoundingly increasing kind of spaces as you go out in time.
Yeah. Which is exactly, that's a great explanation of why, as you go further out in time, you have more Vega, right? Mm-hmm. It's just like, and the interesting part here too, is that, you know, the issue that a lot of people ran into in August of last year, when there was this kind of like a vol issue, it was a Vega issue, and it was really kind of a VIX issue in many ways. And people were reaching for options that had Vega in them. And I think a lot of people were confused because the market was moving size, but the actual gamma options were working because of the move. But what was really going crazy were the options that had not only a mix of gamma and Vega, but the real Vega options. And the reason why is because as you go further out in time, when people are reaching for those options that have Vega in them, they're going for the options that are really rich in Vega and don't really have that much gamma in them. And so you're going to see options when people reach for real Vega coverage, they're going to go further out than like a 10 or a 20 or a 30-day option because of this exact curve that you're seeing here. So also, one thing I also want to bring up here, this is basically the exact same thing, but for what we just talked about, which is gamma. Now, I probably don't have to explain gamma quite as much to this audience as I would Vega because of the actual short-dated options that most people trade. Gamma is a delta sensitivity to stock price. Now, what we talked about here, Vega-wise, is attached to price. It's going to tell you how much the thing is going to move in price terms when you move implied vol. Gamma is actually a measure of how much the delta moves. So technically here, gamma is what we would call a second derivative. Most people don't necessarily talk about it that way because they list delta, gamma, theta, Vega, rho as the big five that people put on their screens. And that's what people think of as kind of like first derivative option metrics. Gamma is actually a second derivative because it measures another actual Greek. So, Mark, what do you think about, I mean, do we need to really talk about gamma here, or is this something that most people understand a little bit more intuitively?
Well, I actually thought your transition there was perfect, going from Vega to Gamma, because the Vega is like like we were talking about. There's the most impact on those further dated options. You're making adjustments to volatility predictions over long periods of times that can really increase ranges and values and everything. Gamma's about delta, like you said, but Gamma's like also where people feel the volatility on the daily basis, right? Where you actually see volatility hit the road when stock moves 2% pre-market or 5% pre-market, or like that's Gamma. And so Gamma's about the change in deltas, but that's realized vol that's like changing your prices there. And I think that's where in some ways people feel that volatility most, actually, out of the Gamma changes in their options.
Yeah, for sure. And what you're seeing there most of the time is going to be not actually Gamma that's the price change, but what's happening is the stock has moved and the Gamma of the option is affecting the delta, and the delta is what is creating the actual price change in the option. So it's kind of like that waterfall thing, but that's because the Gamma is, like I said, it's a second derivative, right? It's measuring how much the delta is moving, and the delta is what is changing the price of the option in like real rubber meets the road kind of terms. So let's also I want to show you exactly what we talked about with Vega, but as a Gamma function relative to time, because what you're going to see is that when you look at this, this is the exact same thing. Remember what we looked at Vega relative to time. This curve went up as we went farther back in the duration curve. And when you look at it from a Gamma perspective, again, driving the point home here is that the zero DTE option that you're looking at in the front of the curve is where all that option is what I call Gamma centric. It has almost no Vega, and it has kind of all the Gamma, right? It's where all of the Gamma lives. That option is going to be really sensitive to movement in the underlying. It's not going to be quite as sensitive to implied volatility moves. And as you get farther out in the curve, what you're going to see is the opposite of that. So let me show you one last slide, which is what it's going to do is it's basically just going to overlay the two graphs that we just looked at. Mark, do you want to talk about this at all before I show the next slide?
Your zero DTE option doesn't care what implied volatility is going to do over time. It doesn't care what the leaps are. It doesn't care what your 30-day is. It just cares where you're going to land at 4 o'clock today.
Yeah.
3 o'clock
And
today.
guys, we do have some
about
text. Sorry, Mark, I cut you off there.
It's just all about today. Like it's all about where we're going to settle, where we're going to measure this particle at exactly 3 o'clock.
Right.
We do have some texts coming in with questions. Do we want to answer those as we're going, or wait till we get through this last slide here?
Let me give you the last slide, and then we'll get to it real fast. So this is really just a function of what we looked at in both of these graphs, and this is what Mark was just saying, right? These zero DTE options, all the Gamma, none of the Vega, basically. I mean, that's a very simplistic way to put it, but that's really what you're dealing with. And then as you go farther out in time, 5 days, 10 days, 30 days, 90 days, you see these options start to lose Gamma sensitivity and gain Vega sensitivity. That means that this option back here is going to be much more sensitive to implied vol moves and much less sensitive to underlying moves, the stock moving. And if you were to blow this out to, many, many, many days or many, many, many months, you would see that these actually they continue to expand the difference between these options. So the reason why we want to talk about this is Gamma and Vega are really important, but they're important in different parts of the curve, duration-wise. And if you're trading a zero DTE option, you're not really trading Vega. You're trading Gamma, you're trading movement, but you're not trading implied vol as much as sometimes people think they are. So that's my spiel there. You want to pick up some questions?
Well, actually, I have one more thing, because today's like a kind of particularly interesting day about this, right? Like we see pre-market, I don't know where we are right now, down 100, down 110, something like that. Maybe only down 80. Who knows? We've been on here 30 minutes. But you might feel like, oh my gosh, implied vol is going to, jump. It's going to pop. And we'll see that in the short term, right? We'll see maybe the weeklies really go up. Maybe we see 30-day vol go up a click or two. That leap vol isn't really going to change that much. Maybe it's up a half a point, maybe it's up a point, But because Vega's so powerful that far out there, if you increase just a half a point or a point, you're actually really adding a lot of juice to those options and really like changing the distribution range that could happen. So Vega, like as it moves, those options further out aren't going to see implied vol shifts as big because their Vega is kind of so powerful, or the effects are so powerful of even small changes.
Yeah. It can be in everything all at once kind of vibe when you get back in the back of the curve, right? You can see implied vols moving kind of in a muted fashion. And then all of a sudden, and I remember this from 2008. 2008 was like people, you'd get these reverberations of things and the Vega would kind of move. And then all of a sudden, what we saw happen was like, oh my God, things just blew out in the back of the curve. And that is oftentimes can be a signal that like, okay, people are now reaching for Vega. People are reaching for these options that like, they need coverage for a massive book that has a lot of Vega risk, right? And that's when you'll see those options explode because of exactly what Mark said, which is that like now the Vega, now people all of a sudden say, okay, there's actual issues in the, solvency of the system, something like that. You'll definitely see Vega options move in that situation, right?
100%. And I think there's also something structural where like, as a community, if I could make a broad oversimplification, like market makers tend to be short that back month and structural liquidity providers tend to be short the long dated options. And so like you can see some book effects on that too, which will cause those jumps as stresses start to hit in different corners.
Yeah, absolutely. I'm going to you want me to pull my screen down? I'll stop that.
That works.
You want to answer some questions, or?
So yeah, we'll pick out a few questions. I've got one here that I think a lot of people are probably thinking, and it says, but we could generalize that as how do traders adjust strategies when Vega is high versus when Vega is low? And then the question is, for example, during an earnings season versus like normal conditions.
It's an interesting question. And I think it's important to make the distinction between Vega and implied vol. Sometimes people get those two things mixed up, right? When they talk about like, how do I adjust the strategy when implied vol is high? That's a measure of like what the level of the price of the option is. When you say, how do I change this structure when Vega is high? You're talking about moving your structure to the back of the curve where there's a lot more Vega. So it's important that you understand how those two words work when you're talking about it. I think I don't necessarily talk about like structures when implied vol is high because I don't make those kind of recommendations, but you can find, and Mark can probably talk about this a little bit better than I can. When implied vol is high, theoretically, people tend to trade things that are a little different than when they're low. Maybe Mark can talk more specifically about that.
Yeah, well, I wanted to pick up on the earnings point of that too, because that's a particularly interesting time to talk about volatility and like Vega as the exposure measure of that, because the implied volatility metrics that we use and like, the way what Vega is sensitive to assumes a relatively even distribution of that volatility over time. That the 30-day implied number says that on average, as an annualized figure, vol will move at 20% over the next 30 days. What gets funky about earnings is that we know there's like a concentrated hunk of variance and news that is going to happen on a specific day. So the volatility distribution isn't going to be exactly the same. It's not going to be 22 consecutive trading days of roughly average standard deviation moves of X. It's going to be 19 trading days of roughly standard deviation X and 1 day of Y because we know a bunch of news is coming out on Y. Right. So I think around earnings in particular, it's important to not say, oh man, Apple vol is 45 on earnings going into this weekly. Like normally it trades at a 22. Like that's a total sale. It's because there's 1 day where Apple's expecting to be 50 vol and 2 other days where it's expected to be 20. Right. So like particularly around earnings, I think there are a lot of traps with looking at just pure implied vol measures.
One thing that I want to add to that, and I think that's a great explanation of what things might look like when you get around earnings. People generally tend to look at earnings of the option that includes the theoretical earnings move potentially, and then the option that might be right next to it or right after it. And that's when people start to look at those, what we call time spreads, and how they actually line up relative to each other, because that gives you an idea of what the market is pricing as far as the move itself. If you look at an option that has the move theoretically included in it, and then you look at an option that might not have the move included in it quite as much, you'll see there's a premium to that move that's built in. And that's when that spread starts to theoretically widen between them. Oftentimes, you'll see them widen before these kind of theoretical moves happen, and then some of that premium come out, and those spreads narrow as you get more information about what the move actually was, right? I think about it as when you have earnings, what you're getting is a vol-reducing event, because now you have more information about what's about to happen on your books in front of you, and you can actually make a decision going forward as to like, okay, now we've got that out of the way, and things sometimes go back to a more normal distribution of how things look.
Yep. And depending on the news, depending on what comes out, what surprises or lack of surprises, that can take 5 minutes, that can take a couple days.
Yeah, that's the other part that's really interesting, right? When things get really wacky, sometimes that, the reverberations of those things will take a long time for things to regulate back to where they were previously. That's something you need to have in your mind as a possibility, especially when you still might have a scenario in front of you which still has a lot of uncertainty built into it, right? Like, yes, the earnings are out and the stock XYZ moved 4%, but, the CEO also just said something crazy that, like they don't know what their earnings forecast for the next 6 months looks like. And that changes things significantly as to how quickly things might regulate.
Mm-hmm.
My head is, I'm trying to soak all this in. This is by far the most, in-depth education we've had. You two going at this is fantastic.
This is great. This is going to make some good content to chop up.
Sure is.
So make sure we share it with you guys. Do we want to do one more question, or do you guys got to get going here? You guys let us know, because we're happy to get into PeakBot picks if you got our jet.
I've got like 5 more minutes, but
yeah, let's do more questions.
Good.
Okay. This one is, I guess, along the same kind of vein here, but I want to talk about this specifically from, and maybe Mark, you could start the conversation here because you're more familiar with the PeakBot user. But when selecting stocks to trade, tickers to trade, options to trade, right? When would you want to prioritize Vega exposure over gamma exposure? Sorry.
Most of the PeakBot strategies tend to be much more about gamma, and much more about, if you're looking out over the course of the week, like I wouldn't really pay that much attention to what your Vega exposure is. Yeah. Implied volatility is important because implied volatility is still going to determine the amount of premium and like the pricing of that option. But that option isn't necessarily particularly like sensitive to those changes in implied volatility. So they're not necessarily like Vega oriented strategies. They're much more about capturing gamma premium, as in exchange for that exposure. So yeah, like I think Vega's really interesting to think about, as Matt adroitly pointed out. It's the back part of the curve that you really have to think about. And once you're going more than 30 days, call it, like, then you're going to start seeing some fluctuations. You might see your covered call that like is out 30 days and goes up in value, even though the market's down because vol changed. Like, so there you can start to see it. But, on a relatively short-term spread, like I think it's that gamma angle. And especially how, options might not change in value up until the very, very end of that, exposure period, because it still has, some potential gamma value. So I think that dynamic is probably far more present in the PeakBot strategies.
Yeah, I agree with that. One thing I do want to add to that is that you can see also within, if you look at the microcosm of like the 5-day option, the 7-day option, the 10-day option, you can see gradations of Vega theoretically in there. But the difference between a 5-day and a 10-day option, as far as Vega is concerned, is, I would say, relevant to those options, but it's not the heart of what's actually going to change price. those options are still going to both be relatively like responsive to underlying movement. There's gradations of Vega that's in there, and the 10-day option, if you move vol, is going to move more than the 5-day option, all things being equal. But what Mark is saying is 100% true. That kind of microcosm here, the ecosystem of the first 2 weeks, is kind of all in the gamma encapsulated area. And then once you get past that, you start to see that, that graph that we showed you. They lose gamma, they gain Vega as you go back in time. So it's not as if every option in the first 10 days is exactly the same Vega-wise. It's just that it's not quite as significant as far as price is concerned. They're all going to move with gamma more than they are with Vega.
So Vega may become a more important metric for PeakBot strategies when we introduce some longer term strategies, such as we're exploring, and this was announced last week, we're exploring like a poor man's covered call option strategy, where you buy a leap and then you sell calls against that leap. And Vega will come into play in that strategy, no doubt.
Vega will be primary, I would say, in that strategy, in the same way that gamma is primary in most of the short-term strategies that you have now, all because of that mix, right? The mix of gamma versus Vega as far as duration is concerned.
Yeah.
Ties in beautifully. It's very poetic. Well,
right.
Do we have any other questions that came in, Ben? Or I know we're getting a little close to market.
Yeah, let's cut it there. We'll have to invite Matt back at some point to answer the rest of the questions and cover another topic, because we love having Matt here.
Yeah, we got 3 more Greeks to cover. We got plenty of content.
We got lots. You want to go out to the second order Greeks? We've got lots of Greeks to cover.
What are you doing Monday?
Exactly.
So no, we'll absolutely be having Matt back. This is a fantastic discussion here, and really helpful for our audience, right? This is man and machine. The more you know, the more confident you can feel about these strategies that are operating. So, all right, very cool. Well, if either of you have to jump, please feel free to just jet at any time. We appreciate both of you. And we can move quickly into just a quick PeakBot picks review. Gentlemen, how you guys feeling? You want to hang around or get out of here?
I got a poll.
Awesome.
All right, Matt. Thanks for hopping on.
So much,
Matt, good to see you.
Yeah, you too. It was wonderful to be here. Let's do it again soon.
Sounds good, my friend.
Let's do it.
See you at the peak. All right, Mark, what's your status? You cool to hang or no?
My guy showed up, so I'm good.
The guy showed up. Mark's got a guy.
We were talking about, having a guy, right, to be there doing something for you. We had some snow up here in the Northeast. You're in Connecticut. He got even more than we did, 3 inches. So plow guy showed up. Mark's here. We're good. Let's talk about. We'll quickly do PeakBot picks. Ben, you got your truck
We're
ready.
15 minutes till the bell. So
all right, here we go. We're gonna fly.
Speed
Ben,
up.
I already have the results. Do we even want to look at the charts?
I guess not.
No, we can. It's fun. Here we
I
go.
like to.
All right,
Yeah,
here we go. Let's get me out of the way. Disney, I was bullish with a put spread, trying to stay over 111 for $40 in premium.
You did.
I did. Nicely done, Dillon. All right, I was bullish on ticker ON, not to be confused with ticker ONON, just ON. Over 58, not so good. Not so good. In fact, really bad. Nike, bearish, which has just been the trend for the last few months. Under 76 with a call spread.
Wow. Not good for the win rate.
1 for 3 for your boy over here. Not good. Ben, CCL, bullish put spread. You're trying to stay over 24.5 for $10 in premium.
There we go. Here we go.
Here we go. We got some steam. All right. Zim, bearish, ZIM, under 18.5 for $10 in premium.
Did it.
Scraping the bottom of the barrel there. 2 for 3. Ben, bearish on Lilly, ticker LLY, under 805 for $366 whopping dollars in premium, and he misses out. However,
so close.
With that much premium earned and it being that close, maybe even a winner there. Not sure.
No, too far. Too far out.
Okay. All right. So Ben, you went 2 for 3. I went 1 for 3. Let's see what Thomas can do. Thomas, IWM, bullish.
Thomas
over
went with
227. He chose the direction. It was neutral. He chose the direction and came up short by just about 50 cents. Tough to see. Thomas bearish on Pepsi. That's a staple for him. Under 152.5 pays off. And what this is going to come down to is if Thomas nails this, it's going to come down to premium made on the winning trades, and that's going to be close. PG, bearish. He was trying to stay under 167.5.
Oh, man. He definitely. My two winners were only $20 in premium.
Yeah, so when we look at the chart here, Thomas is going to take the W, okay? Because Ben only made $20 in premium. Thomas covered that significantly with his two wins. Not a great week for the boys, generally speaking. 5 for 9, our lowest week in a very long time, maybe.
Yeah.
Tariffs. Quickly, let's look at the stats. Ben, you're catching up a little bit, okay? So Thomas will take the W. Win rates, Thomas is still in third, but he's now within, arm's length here of us. But win rates, Thomas is now 45 for 54 with 83.3%. I am 43 for 54, 79.6%. And Ben is 39 for 50, now at 78%. All good win rates. Did not improve, though, this week, and that will continue to be tough unless we all go 3 for 3. So hang tight. We'll have picks expiring Friday. We'll be live to check them out. So, but yeah, week 18 of the contest, Thomas takes the W, and that is it. So we can do, if we'd like, some quick SPY analysis if we want, or economic events. Let's get out of here. Let's get out of here.
We gotta get going.
Quick SPY analysis is hold on to your seats. We're down 100.
Yeah, there you go. That's a good one. Pre-market down. Who knows what's going to happen? Last only thing, we have a full week, right? Full week of trading. Yep. No interruptions. Yep. Any big high-level events coming out of FOMC? I guess nothing crazy. I know we wanted to get out of here, but I just want to make sure our traders were aware. Just a quick glance.
Spots will be off if there are big events. Check the inactivity calendars. Friday, we've got some unemployment data. That's what I'm looking at. That's about it.
I'm muted. Sorry. So, Mark, any closing statements on a great show? By the way, our 99th show here on the Tradier Hub.
We got to do something special next week.
Didn't mention that. Well, here's the thing. Friday counts as 100, Mark. If you want to come on, come on, dude, join us for you deserve to be there. If you're not busy at 11:55 a.m. Eastern on Friday, you'll tune in. You'll come on.
For the 100, I think I can make that work.
All right.
And we'll bully Thomas. It's going to be great. We'll just,
I think to celebrate, we should all have McDonald's and eat McDonald's live.
Dude, you're killing me, man. I had Caniglios yesterday. My diet's been ruined. Anyway, all right, everybody. We got just a few minutes till market opens, so best of luck to everyone here this week. Again, thank you again to Matt Cashman, Principal of Investor Education over at the OCC. And I guess that's it. We'll be live Friday. Check us out for episode 100. We'll have some fun giveaways and promotions going on. And maybe we'll all be eating McDonald's, but I sure hope not. Thank you, as always. Almost 1,300 live viewers this morning. So thank you, everybody, for tuning in. And as always, we'll see you at the peak. Take care, everybody.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.